Term insurance, also known as temporary insurance, is typically the starting point for providing a client with basic life coverage. This type of insurance has an expiry date, which means the coverage will not last for the rest of your life. Key features and duration. Term insurance can cover periods like 20 or 30 years, or it can be set to expire up to a certain age, such as 65 or 75, with age 75 being the most popular limit. If the person insured passes away during the specified term period, the coverage is in effect and a death benefit is paid. However, once the expiry date passes, there is no longer any coverage. An important feature is that term insurance has no residual benefit or cash value. It is not considered an asset and its value does not increase. It is sometimes compared to car insurance on your body. Term lengths can range from 1 to 30 years. Generally, the longer the term, the more expensive the premium because the insurer takes on more risk, as there is a higher chance the life insured will pass away over a longer period. Term policies can only be issued before a certain age, usually between 75 and 80, and the end age for policy expiration is typically between age 65 and 100. Types of term insurance products. There are 4 different kinds of term insurance products. The first type is level insurance, level coverage, where both the coverage amount and the premium remain the same for the entire period. For example, a $500,000 coverage stays at $500,000 for 30 or 40 years, and the premium is fully guaranteed. Second is decreasing term, which is commonly known as mortgage insurance. With this product, the amount of coverage decreases year by year, usually aligning with the balance of a mortgage or loan. Even though the insurance company's risk decreases as the coverage goes down, the premium remains the same throughout the term. The third type is increasing term insurance, designed for individuals who are concerned about the erosion of purchasing power due to inflation. The coverage amount increases annually, which may be tied to the Consumer Price Index, CPI, or a fixed percentage, such as 2% or 3%. Consequently, the premium also increases accordingly, meaning neither the coverage nor the premium remains level. The fourth type is renewable and convertible term insurance, which is arguably the most popular level term product. This policy is designed to be more affordable initially, as the premium starts considerably lower than a guaranteed level premium. The renewable feature means the policy automatically renews every term period. Example, 5-year, 10-year, or 20-year renewable. A key point is that the premium increases significantly at each renewal, with these increases clearly listed in the contract. When it renews, 2 rates are considered: the guaranteed amount, which is the worst-case scenario premium stipulated in the contract, and a reentry rate. The reentry rate is a lower rate that may be offered if the client undergoes new medicals or underwriting and is found to be very healthy, such as not smoking. If the reentry rate is established, the client pays that lower rate for the next term. The convertible feature allows the policy to be converted into a permanent policy, often without the need for a medical exam or new health questions. Types of term insurance coverage. Term insurance coverage can apply to 1 or 2 lives. Single life coverage involves 1 life insured, and the death benefit is paid out when that single person passes away. Joint life coverage insures 2 lives, but the death benefit pays out only once. Options include a first to die or a last to die payout. This is a cheaper policy than a single life policy because it only pays once, and it is often used for specific needs like a mortgage, business support, or estate planning. This is different from a combination insurance policy, which only saves money on administrative fees. Advantages and disadvantages. Term insurance has several advantages, including that the premiums are set, level, during a term period. It is generally low cost in the early years, making it easy to afford and to understand. Additionally, policies are often automatically renewable and convertible. Finally, the policies are customizable, allowing the client to choose the term length and death benefit. On the other hand, term insurance has disadvantages, such as the fact that there is no cash value and it is not an asset. The value of the death benefit does not increase. The policy ultimately expires, ends. Furthermore, the premium increases significantly at each renewal. General life insurance definitions. These definitions apply to both term and permanent life insurance policies. The insurer is the insurance company that issues the policy and eventually pays the death benefit. The policyholder is the owner of the policy. The life insured is the person whose life is insured, and their death triggers the payout of the death benefit. The beneficiary is the person who receives the death benefit. The policyholder and the life insured can be the same person or different people. For example, a parent can be the policyholder and the child can be the life insured.